Web3 nomads. Everywhere jobs for anywhere people.
Okay, that seems stable. All right, we're live. We've got Devin from GammaSwap. I've been pestering Devin for a couple of weeks now, so really glad to have you here. How are you doing, sir? Okay.
Doing well. Yeah, super happy to be on the pod and to be chatting with Blockades. Yeah, been a fan of your content for a while, and been really excited by some of the guests and projects you've been having on recently. So excited that I could be part of that group.
Absolutely, yeah. As I was saying off, not to kind of pump your own ego bags or anything, but you guys were on like our top priority list to get on, particularly in Q1. The other one was Eigenlayer, which we've managed to nail for next week. So good company.
Yeah.
So you guys are up there with on our top most wanted list. Effectively, it's wanted posters all around Blocknight's HQ.
Eigenlayer's a funny one, actually. I met them at SBC, and they started telling me their idea, and I was just like, "Whoa, this is really cool. Like, I think this is gonna be a big deal." And then, I think some of the innovations you're seeing, like in liquid staking, with some of these decentralized like staking products. I forget the exact name. These like type of vaults that are coming out. I think there's gonna be like a lot of flexibility with staking and higher yield as well. So I think it's gonna be really bullish for Ethereum, just because those yields are gonna start becoming extremely competitive, and people can opt in to the extra slashing risk, and maybe even kind of like third parties on top will start evaluating the types of like slashing and the types of projects that are offering these rewards. So it's even easier for validators to kind of like decide what layers on top they want to kind of be a part of.
Yeah. So which podcast is going to be more confusing for the novice? Is it going to be this one, or is it going to be Eigenlayer?
I guess it depends on, I think, the person, right? Like the DeFi native person, maybe Eigenlayer would be a little bit more confusing. Hopefully, at least we're not that confusing. But I guess if you're really into infrastructure, I mean, Eigenlayer could be a little bit simpler to understand. I think I think it just depends on where you are. We're definitely working on kind of simplifying the way we describe our protocol, because I think initially it can be a little bit hard to wrap your head around.
Yeah, just messing. We'll try and slow it down and pick it apart, because once you do sit down, it does make an awful lot of sense. So usually I like to just take a step before we get into the product and the project, and just ask the people who were on the other side of the mic, effectively, how many kind of bangs to the head did it take for you to get into this industry, and like what was the kind of origin story there?
Yeah, so let's see. I first started getting into it just because a friend told me about Bitcoin, and basically how it was just this untraceable money. You could do anything with it, not connected to any kind of like nation. And I thought that was really cool, because I've always kind of seen myself as a libertarian and not really been super trusting of the government. So I was like, that's really awesome. I guess it didn't really appeal to me until I guess I started really like thinking about like Ethereum and all the like possibilities that were possible with that, like creating any application like an Uber or whatever that wasn't owned by a single entity and was just this contract that lived forever. Like that's when I really started to like look into it more and do more research. But I would say for me, my journey in crypto really started in 2016. I was just doing some arbitrage on like centralized exchanges, taking advantage of the kimchi premium a little bit. And it took me a while, I would say, to get into like crypto Twitter and DeFi. That probably happened around 2019. So in between, I would kind of like follow the forum posts and look at different projects. My friends and I would send each other, but wasn't like super active, I would say, in the community, but kind of knew what was happening. And then, I had graduated, was working in tech in San Francisco. So just for some tech startups. And I don't know. I kind of started to see like SaaS especially become like really niche. And then as I started getting more active in crypto, I felt like there were a lot of inefficiencies and a lot of like big kind of like game changing things happen. And I think two, what attracts me about crypto is one, I felt like more aligned with the people in terms of like values, like libertarian values. But also, I just feel like there's always something happening. Like the space moves so fast, for good and bad, it's impossible to get bored. Like 2022 was probably not the best year for crypto, but no one can like say it was boring. So I just thought it was like a really interesting space to be in. So kind of quit my job just to work full time for a year in the bull market. Was doing some trading, some consulting, and then found an interesting opportunity through a friend at Figment. They do a lot of proof of stake infrastructure. And yeah, wanted to get more into kind of like the infrastructure or kind of like middle layer. That was like some of the more interesting things happening in crypto. And then in May, I was a judge for a hackathon, Activate X Wormhole in Miami. And that's where I met Daniel, our CEO, and our other co-founder. And the idea really appealed to me because, I had LP'd for a while and really didn't make much sense in a lot of these chains and pools just because the APYs were so low and, the volatility risk was high. So would only really do it if a new pool just popped up on like a chain or it was like a new project doing, some crazy like liquidity incentives. So that idea appealed to me. It's like, okay, a way to hedge or at least be better compensated. But when I started to like meet the team more and see like the long-term vision, I felt like I regret it if I wasn't full-time. And so I joined full-time. And where I've been helping out just based on my background, I can code a little bit, but where I can be the most helpful is like growth, like marketing, operations, partnerships. So that's kind of where I came in, getting our presence out there, connecting. We're at the tail end of our seed, so connecting with investors, partners to build structured products with, or kind of like in the Arbitrum ecosystem. So that's where I've been really focusing on as well. And then just some of the product as well. Really trying to simplify it and have an experience that's more retail friendly. Because I think initially with some of the articles we posted and even our initial version of testnet, it's still kind of hard to get your head around and understand exactly like the risks and the potential upside that you're going to have from using it.
Yeah, it makes sense. I think it's the same as anything though. Like until you become part of the furniture in this space, it's like I remember the first time using a bridge or depositing liquidity into the Uniswap or a yield aggregator. Like it was all daunting and confusing. Jesus Christ, the first time I used a bridge, God, honestly, the waiting time in between that, I just thought it was all over.
It's anxiety inducing, especially if you have like any serious money that it's just like somewhere in the nether and it might never come back to.
But it's I think obviously it can be kind of seen that way. It's an innovative and novel product, so it's always going to be met with that initially. But as you say, as it gets woven into the fabric of this space, I think it just becomes more and more accessible. And I'm sure you guys want to get onto this layer, but I'm sure you guys are making kind of headway on trying to make it even more accessible and user friendly. But just before we get into that kind of all that good stuff, how was, I suppose, was the idea with you early with Daniel? How was this born out of an opportunity, necessity, frustration? I suppose it's very obvious to see now. I just thought if you'd told me 12 months ago, I was just like, impermanent loss is just a function of the There's nothing we can do about it. It's just part and parcel of providing liquidity on chain. So how was the product, and what's the origin story of the product? If there's anything juicy to get into that.
Yeah, I think there definitely is, and I think I guess to take a step back, like I think a lot of protocols try to remove impermanent loss. I think we're trying to help people hedge their exposure and be better compensated for it. but I think it's not something we're trying to like remove, because I think there has to be like risk somewhere, right? Like if you're taking any type of position, spot, options, there's some risks, right? The problem is when you're not like adequately compensated for that risk. And I think that's been the problem with AMMs, is that, the Black-Scholes model was invented. We learned to price options through volatility and not the price. And that's that led in the 70s when that was created, that led to like a huge splurge in like derivatives volume. I think with AMMs, not only has it been difficult to understand and people measure it by the APY instead of like, the implied volatility, but also that, it's kind of like a one-sided market, right? Like if people could only sell a stock, of course the stock's price would go down and it wouldn't make sense to buy it. And I feel like that's where AMMs are right now. It's one-sided. No one can take the opposite bet. So yeah, that's probably going to lead to inefficient market. And I think what we're trying to do is enable people to take the opposite side of the bet. So not only will people be able to like get options exposure on any token without being liquidated if the price moves against them, but also you have people that are LPing now that are earning some of those fees from essentially like writing those options. And we think because in like a normal options market, the edge has been to volatility sellers. Like implied volatility has overstated historical volatility 83% of the days since 1990. So 83% of the days, the edge has been to volatility sellers. If we do something similar in AMMs, then we can actually have LPs that are coming out ahead on average. They'll still have that risk of impermanent loss, but they're being better compensated for their risks. So I think that's what we're really trying to solve for, essentially being kind of like this middleware solution or modular scaling layer for different AMMs. And I think even in crypto, we might even see a higher bias. Technically, it should be like equilibrium, but people are biased because they're risk adverse. They're buying these options to like hedge, or just because they think there's going to be more volatility in the market than there actually is. But then in crypto, I think it's even more biased. I think that was a question we got a lot. Like, what's the demand for volatility? I think you look at something like GMX, like there's so many people buying volatility, like even for crypto, like less volatile periods, because it's still a more volatile market than probably most asset classes that are out there. So I think there's always going to be that demand for volatility. But the origin story, Daniel is kind of like the chief architect, and so it was really his brainchild. But he used to be at Wall Street and was a quant at UBS until 2016. And they started putting restrictions on people trading crypto in their personal portfolios. So Daniel had saved up enough and had been involved in crypto since 2013, like mining some early alts and selling them and accumulating BTC. So he had enough to kind of just to try his hand, like doing it himself. So he's been trading his own strategy since 2016 and successfully. So in 2020, he heard about Uniswap V2, was providing a lot of liquidity. He had BTC and ETH exposure they didn't want to sell, but wanted to be a little more capital efficient, earn extra yield on. So he's like, okay, these contracts are paying out 1,000%, and impermanent loss might be a thing, but even if it's like 3% a day, you're going to get paid. You're getting paid out like on that risk like really quickly. So it wasn't really like a huge issue. But then a lot of those liquidity mining contracts kind of disappeared, and so the APYs were either higher, kind of like on those altcoins, but you're taking a big risk and can't hedge that, or like something like ETH USDC, which of course is those are tokens that I think most people want to accumulate. The APYs were so low where, when he actually did the math, he realized that it was a negative expected value trade, that he would probably end up losing money instead of making it through these pools. So then, I think it was two things. He was in New York at the time, so he couldn't really look into all like the on-chain derivatives and like try to build something there or hedge there. So he started to think about, what if I just take the opposite side of this? And realize like short liquidity, and realized there were no DeFi services doing that. And so he ended up moving to Florida because New York's probably not the best place to be a DeFi founder. but yeah, and trade derivatives. But went to Florida, started working on this in mid 2021. That's when he started developing this contract and realized that it was something that seemingly was technically feasible. Started writing like Medium articles on the math to get people's feedback, and another DeFi founder like invited that wanted to use GammaSwap, invited him to that hackathon just so he could get exposure, like build a team, and luckily that's how I met Daniel and our other co-founder. So this is definitely good advice, and we've all kind of been working on it full time since May, in terms of continuing to build the smart contracts, the UI, getting a presence, building a community. So we've all been working on this full time since May, so it's about 7 months now.
Wow.
Yeah, doesn't feel that long, but it's been a little bit.
Yeah, I bet it's mental. Just the early stage of any product or startup, it's those crazy days. But you probably look back on these in 2 years, 3 years time and think, they were the good times. But so if we kind of strip it back, for even if anyone's listening as a new kind of market participant or anything, what are the current issues that you're seeing for LPs, or what is the kind of bugbears that you're hearing from kind of people that are interested in the product?
Yeah, that's a good question. I mean, I think the biggest problem with like LPing, well, I think there's a few. The one that we're, I guess, most clearly solving, at least initially, is the problem of not being fairly compensated for that risk. So I kind of mentioned how, implied volatility is really depressed in a lot of these AMMs because there's no way to buy it out. So what we're trying to do is create a two-sided market so that people are being paid for the volatility risks that they're assuming, being paid better. And we think if we build this, our theory is that on average, LPs can be passive and still be positive EV on average. So that's really, I guess, what we're building towards. I mean, I think there are other problems as well that we're not necessarily looking to solve or don't have a solution for, but have identified. I think one thing is concentrated liquidity. So we're not against concentrated liquidity at all, but I do think it's added a lot of complexity for projects. For example, you can have liquidity mining incentives on UniV3, but the algorithm is more complex. And then you have to, I guess you have to find a way to turn it into an ERC20 token. We haven't exactly looked at that part, but the algorithm is more complex. And if you're a new project, it's going to be more capital efficient, but like figuring out those ranges. So I think there's a lot of layers coming on top to help projects do that. Like we're seeing Arrakis and Gamma Strategies, great name, coming to help projects like kind of do that. But I think we're going to need to see like more layers on top. Like I think something with like UniV3, eventually like retail is not really going to interact with it directly, and it's just going to start interacting it with more layers on top. So I think it's become more complex, and UniV3 was kind of this solution, which I think ultimately the true value is that it helped with slippage, but part of it too was like, okay, fees aren't accurately compensating LPs, so we'll let them shorten the range and then they'll get more fees, but they're now assuming more types of risks, which I think for some people that's a good trade-off, and other people are looking for more of a passive product, right? Like that was one of the really cool things about like Uniswap v2 is anyone can be a market maker and you don't even have to think about it, right? Like something maybe like APE where you just provide the tokens and you have an APY and you can just expect that you're going to get that yield will be variable, but that you're going to get like a stable yield for providing liquidity. And like I think GLP has lived up to a lot of that. Like there's some risks, but kind of simple to purchase and not much management too. So we're hoping that's what, either through these layers on top of UniV3 or through something like us, like that's where the space will go, becoming, because I think to attract more users, even if kind of like the deeper layers are complex, like the layers that users should interact with shouldn't be as complex. Like some products I think will be, and it will attract those types of people. But like the main products that are going to attract the most TVL should be the ones that are really simple to understand. And I think that's why, even now when we look at like the highest TVL numbers, like MakerDAO, like Uniswap does more volume than Curve, but Curve has a higher TVL just because, as an LP, it's simpler to understand the risks and just really easy to provide liquidity like passively. And so I think that's another problem. It's not necessarily fully a problem because I think there are actually benefits from the UniV3 model. I just think we don't have those layers on top necessarily where everyone can like participate with like that type of in the ways they want to, either more actively, but also have the options to be more passive. And we have these tools coming into fruition, but they're still quite early, and there's only a few of them. I think there need to be quite a few more to really enable, kind of like universal access to different participants.
Yeah, obviously you might be a little bit biased to this next question, given building around the AMM model, but how do you feel about the space holding on to the AMM model as opposed to, I don't know, maybe further down the line we start to begin to see some order book stacks popping up, or a hybrid model? Are you kind of waiting for the right chain for that to allow that to happen, or how do you guys look at that?
Yeah, I think for good and bad, we have pretty strong opinions on the types of products that should be in DeFi and do well in DeFi, and the types of products that shouldn't. I think I think the promise of crypto was really to take away power from centralized institutions and third parties and really just be this peer-to-peer system. So when I look at like models for DeFi or any system, it's okay, how can we make this as transparent and as accessible for like the average person as possible? So in some ways, I think there are good institutional products that are coming, but I don't really think that's necessarily what the space is about. And particularly for like a CLOB, what worries me about that is you're going to have, we got some pressure to do this when we were first launching. You're going to have all these kind of market makers from TradeFi just fork over their strategies that have been battle tested for like 30 or 40 years and market make. And basically, I guess there'll be some deep liquidity, but the execution you get, not that it's the best in DeFi yet, but in some ways, I guess you'll get better slippage, but in other ways you might be being traded against. Plus, I think, it's going to make it even harder for the average person to market make. Like, UniV3 is kind of this hybrid CLOB AMM, I guess leaning a little bit towards the AMM, and that's already hard for retail to participate with. So like something like a CLOB will be even harder. And so I think it's really, I don't think the point of DeFi is to look at TradeFi and bring those systems in. I think in DeFi, we need to create new systems that are fair, that allow everyone to access them and participate, and are fair to the average person, to retail. So maybe there's a new type of CLOB that enables this, like some type of hybrid model that maybe I just haven't thought of, and I'm sure people might come out with interesting designs there, and I think I'd be in favor for that. But like a pure carbon copy of like the traditional CLOB, I'm not sure that that's going to be the best for the space.
Yeah, I like my market inefficiencies. I don't like 40-year tested algos trading against me, to be honest. I'll go and find some liquid DEX in some unknown chain to trade on. So there's this kind of phrase of impermanent gain floating around. I thought, who better to ask than yourself? Can you fill us in on that?
Yeah, that was the phrase we created, actually. So basically, if you're assuming impermanent loss risk, selling volatility, then if you short that, you'll get impermanent gains. And I think we've learned a lot about impermanent gains, actually, just starting to play around with some of the data. For example, if you weight like one of the tokens, basically you don't have to provide collateral on our platform in 2 tokens, you can provide it in 1. And then you get payouts that look like a synthetic call input. So with something like a weighted pool, like a balancer 80-20 pool, if the leverage, because the gamma is not the same, the delta in the AMM versus like a perp. So it's like a completely new type of option. So like, for example, with the perpetual future, you could get like 50x leverage and expect to have 50x leverage the whole time. But if the price moves against you, then you could get liquidated. In our platform, you basically can do a synthetic call and put where it's hedged, and you get more leverage as the price moves away from your original position. So you could get, with like a weighted pool, something like 10x leverage if the price moves 2x on any altcoin. So you could get like 20x. And then if the price moves against you 100%, not only would you not get liquidated, you would be in profit of about, well, depends how much, but like 10 to 20%. You would get liquidated if the price doesn't move at all. So if it stayed in the same position and you weren't able to top up your collateral, that middle range is where you actually get liquidated. So yeah, you're betting on volatility, but it opens up really cool new strategies because now you're always hedged. You don't even like that. I think that's what we're trying to kind of like harp on, is that GammaSwap will enable LPs to be hedged essentially, because that interest rate's dynamic and they'll earn more fees as there's more impermanent loss because there'll be more demand for volatility. Then the options traders have essentially covered calls and puts without having to manage any of the complexity on their own. So I think it's going to open up totally new types of strategies and strategies, that are, just completely different than have been seen before. I don't want to necessarily say better, but there's just going to be more optionality in the way people open up positions now, which I think is really cool.
Yeah, so I think you kind of touched upon it on there, but I was just going to ask if you're benefiting from price action to the upside and also somewhat price action to the downside, or the volatility if the price action between both assets and the pair was relatively flat, is that where you're getting into the losing side of that bet effectively?
Exactly. So if the price action doesn't move at all, because how the P&L function essentially is impermanent gains, so that's the volatility minus swap fees that would have been accrued on the LP position, minus the borrow fees. And there can be liquidity and mining incentives on our pools as well. And that's not going to factor into the option traders P&L at all. It would just help attract more liquidity on the other side. So where impermanent gains happens if basically what happens is you provide collateral in one token, both tokens, and it could be weighted. And we basically redeem the liquidity position you have, like liquidity invariant, for the underlying tokens. So essentially now you're kind of holding the underlying tokens. And then if there's any volatility, the LP position is basically undervalued in comparison to your original position. Like it can't be redeemed for the same amount of underlying tokens. So any volatility is actually helping you. But when you weight it, that's what's kind of changing. Like you can change so that it's more weighted for more upside or more downside. And then you also have a normal straddle, which is kind of impartial. Like it's going to look the same on both sides. So that's where the interesting things come in. But it's still kind of the same concept that you're betting on the volatility, and you get, instead of having the price move against you, and that's how you get liquidated, it's if the price doesn't move at all. And then, maybe the APY in the underlying pool is getting higher and more people are buying option positions. Like that's where you could get liquidated. But we think you could still hold these option positions for quite a long time. So you could even have them, maybe a little bit passive. So essentially what we're going to do is we're going to enable people to like change their LTV ratio. So the lower, we can do like 90 to 97%. And the lower the higher your LTV, essentially the closer you are to liquidation, but the more leverage you'll get. But even something with 97% LTV, if the APY in the underlying pool was about 1,000%, it would still take about 24 hours to get liquidated on that position. So if you had something that, we're seeing on average more like anywhere from, 5 to 30%, that could take a week, maybe 2 weeks, depending on also the demand for volatility to get liquidated. So you could have these kind of like option positions outstanding for a decent amount of time. So yeah, it's going to be interesting to see how it kind of plays out, but we're just kind of excited not only to help. I think the two big things that we can help with if the model works is just attract more liquidity to AMMs, like more TVL to DeFi, but also give options traders like totally new ways to trade options and to be able to do that on any tokens, like any altcoin, which personally I'm going to be doing a little bit of and pretty excited for.
So let's say, just hypothetical, just so I can kind of picture this properly. Let's say instead of me putting on, let's say I was going to put on a spread trade, so maybe long Sol, short ETH, instead of, I don't know, instead of opening leverage long Sol and short ETH, or spot long Sol, short ETH, could I effectively use GammaSwap to bet on the volatility and the spread between the price movements between Sol hopefully moving up and ETH moving down? But even if I was completely wrong, I still wouldn't be wrong because I'd still be in profit as long as the volatility is there.
Right, exactly. So you're just betting on volatility, and you can, so like you could take a call on Sol so that in comparison to ETH, so that if the price of Sol, the volatility of Sol, the price of Sol appreciates in comparison to ETH, then you get more upside that way. But you would still be in profit if it moves down just less than like the normal straddle position. So you'd be betting on either Sol or ETH, the volatility in comparison to that other token. So it's almost like the volatility between those tokens. Then, the way you would get liquidated if there wasn't much volatility and there was a lot of, volume, like swap fees, or just a lot of demand for basically the options on that token pair.
See, that's really interesting, because instead of eating a lot of, depending on what exchange you use, instead of eating a lot of funding rate, depending on how long you want to keep that open as well, it might be more cost efficient in that regard.
Yeah, I mean, to be honest, there's probably going to be some arbitrage happening between different types of tokens. It depends on it. The more clear one is like the pool. So if we have a wrap pool, and let's say like, Sushi, ETH, USDC, and then we have like the TVL theoretically in our pools, the wrap pools on top of these other AMMs should be higher, because to achieve the same APY, you would need a higher TVL on our platform, because you're also earning the borrow fees. So that's a more clear arbitrage opportunity. The options, it depends, but I think there still could be some like arbitrage between like things like Deribit or other like DeFi options, like especially like some types of Atlantic straddles. I guess it just becomes a little bit harder with the expiry, but there's still going to be some arbitrage available there. Yeah, we're hoping, if the model does well, that other projects will kind of build, different variations of GammaSwap, like on top, like GammaSwap calls with 2-week expiries, GammaSwap straddles with 2-week expiries, like new tokens. Instead of launching a pool, they'll launch a vault that's hedging IL for you and provide tokens incentives on that. So I think there's a few interesting things that new projects could leverage GammaSwap for if we were able to attract liquidity.
Could someone use it to hedge against depeg risk?
Yeah, that's something we've been thinking about. So I'm not sure exactly how we should like package this, but essentially you could have USD fracs, for example, USDC fracs, and then you could take a straddle out on the one you think would depeg, either USDC or fracs, and like profit off of that. And it'd probably be a pretty cheap way to buy depeg insurance, because I imagine the demand for that's not going to be as high as something like USDC. But we've been thinking, like, should we just let people do that and that's how they'll hedge, or should we create like a new type of product, maybe that's I don't know, has like a different kind of like interest rate curve or something, or I don't know, maybe another project could do that. But I think it's something we could do. It's just not something we've necessarily optimized for yet, because I think there would be different considerations on how you would do that. maybe we have to look at the math more, but maybe if we just did like our wrap pools on Curve, because they're already their algorithm is already optimized for stables, and maybe that'd be like an efficient way to hedge against DPEG insurance. But so it's possible. It's just something we're still honestly thinking about. We haven't really figured out the best implementation for that.
Yeah. So with regards to the LP positions, you mentioned Curve. We've talked about Uniswap. So what's the landscape going to be like there, or what is the kind of, I suppose, what does the user flow look like? Can we hedge against any LP position? Do you have to come to LP on Gamma? Like how does that whole thing think about?
So yeah, I guess firstly, something interesting about protocols that our code's modular, so it can work with any AMM. So we're starting with UniV2, Sushi, any like UniV2, we don't have to build an adapter for, but any other type of AMM we usually do. So Bouncer, we're building the adapter right now, and then we'll build like UniV3 shortly after. We could also do Curve, but like it's something we're interested in. I think it would be mostly used as like a DPEG insurance tool. Just still thinking about, if we're going to be the ones to build that and not incentivize, someone else to build that, like what would be the best way that would look, and like how would people want to consume a product like that? But essentially, let's say Sushi Swap, right? You want to provide liquidity in Sushi ETH USDC, and you want some extra yield for that. You could come to GammaSwap. You could search like basically filter AMM chain, or just search the token. So let's say it's ETH, and you can see all the different different AMMs, pools, and chains that it's on, and just choose that. And then if you're already LPing into Sushi, you could provide your LP tokens. If not, you could do the ETH USDC, and then you could see, we're not going to compare necessarily our APYs to the underlying pools in our platform, but you could compare that yourself and see that. And then, as an LP, there's no additional economic risk, I suppose. It's just purely smart contract. So we're going to get audited for that, and of course have our code open source so people can look at that themselves. But essentially, if our smart contracts are secure, then there shouldn't be any risk, and you'll earn additional yield. The only exception is maybe, some projects incentivizing like a Sushi pool and not the same Gamma pool, and then the utilization on that Gamma pool is not that high. So then there might be a case where the yield in the underlying AMM is higher. We're hoping, that if we gain traction, new projects will also incentivize our pools. But that could be that could be a reason why someone wouldn't want to provide liquidity in GammaSwap instead of we want to provide liquidity in the underlying AMM instead of GammaSwap.
Yeah. Could you not cut, like, there's a lot of I was on the tap talk with the Tapioca guys, and they had Carvus from Lido, and they were speaking about effectively emissions spent to, money out compared to how much you're bringing in per Lido token effectively. Would there be no way to incentivize treasuries with large protocol or liquidity instead of having to, go and waste tokens on emissions on another platform? They can come to Gamma and strategize that way. I can imagine there's going to be a lot of projects that want to deploy with you guys, to be honest.
Yeah, I think that's something we've been thinking about a lot, is that where we see ourselves, not necessarily from a liquidity perspective, but just, I guess, value add towards the space, where we really see ourselves adding values to new projects. Like I think if I'm going to launch a new project, let me actually think of this from an LP perspective. Like I see a new pool, and it's an interesting project. Let's say it's this new project on Arbitrum, and they're doing something really innovative, but maybe the team's anon, or maybe it's still a bear market, and whether you think it's a bear market or not, but let's say it's a bear market, and you just don't really know how the token's going to do. And it's like, okay, I want to add liquidity here. Like I'm bullish, but I also want to hedge some of that risk just in case, things don't go in my way. And there's no way to do that because, that token isn't supported by an Oracle yet. Maybe I could maybe, let's say it's a project that is able to get on an Oracle somehow or get support there. Even if you're using like a perp or borrowing, the delta that's one, well, like the delta in AMM's changing. So you would have to rebalance a lot. So it's still kind of awkward to do. And it's not done for me. Maybe if I'm more retail, like that's not something I just know how to do or want to do on my own. And so, there's a lot of volatility risks. You're going to have lower volumes with the new token naturally. And then the volatility is higher because the float's lower, it's newer. And so it's pretty hard to LP into that. So you have new projects that, whether they're renting liquidity or just trying to compensate their LPs better, are giving away a lot of liquidity incentives. But then, I think sometimes inflation can be good, but if you're forced into doing something inflationary for your tokenomics and that hurts your project, it could be something really innovative, but the token is kind of like down only. It's hard to kind of bounce back from that. So we're hoping that, we can give basically ways to hedge and better yields to LPs for new projects, because now with a new project, the volatility is super high and the volume's low. That should incentivize a lot of people to buy options on that because it's super profitable. And then those LPs are going to earn a lot of fees from those people buying options, and they're better compensated. Plus the fact they could hedge, like maybe that new project could build a vault so that people are automatically hedged, or you're providing liquidity and you're kind of like a pseudo hedge because, like I mentioned, that interest rate's dynamic. So, there should be a correlation between periods of higher IL and periods where you're earning more fees from options traders because there would be more demand during those periods. So we're really thinking that, this would be a better way for new projects to launch and not have to offer as many liquidity incentives to compensate LPs. They can just attract liquidity in a more scalable way.
Yeah, makes sense. How's testnet going?
It's good. Yeah, we it's very MVP. It's not the testnet we want to launch with, but we just figured let's get something out there because there are assumptions we're going to have and the way we're building, and it's probably going to be wrong. So in some ways, so let's just get feedback from the community. So with the testnet, it's actually not based on any real prices. It's not connected to subgraphs. It's really just like testing the user experience. And so we've gotten a lot of good feedback. And we don't have an incentivized testnet. We're able to get over 15,000 testers in a month, which was pretty crazy. Was really exciting to us and honestly overwhelming, but in a good way. And then so we learned a lot from that. Basically, we really rethought. I think the providing liquidity side, we're just gonna kind of be like a normal AMM. No reason to reinvent the wheel there. It's already working well in terms of a UI perspective. But on the long volatility side, how do we make that the easiest and most intuitive for people and something that's familiar? So now we've been building something completely different and revamping that whole side. And we're hoping before our mainnet, we can do kind of like a beta testnet where hopefully we can have our subgraphs in place by then, but have some real prices, enable people to test strategies, have the UI that we think is going to be easier for people to use, and see how that one plays out before launching.
Yeah, great. Glad to hear the feedback's been good. I came across the recent kind of governance proposal with you guys in GMX. Can you just explain what's the idea behind this? What it's all about? What's the kind of synergies, and is it mutually beneficial for everyone? Or
yeah, no, I think it's something we've been talking about the GMX team with a while. So we're pretty close to them. A few of the co-founders have participated in our seed round, and I think we have kind of similar. Even though we're not totally different products, I suppose, but two very different products with two very different innovations. I think we kind of see the same things. We have similar thesis on the space in terms of people wanting volatility risk, people wanting to trade, people wanting to get leverage and have that optionality in a DeFi native way. And then the way you attract liquidity is having market makers be passive, enabling retail to participate in market making. Not only I think is that really what blockchain's about, but I think it's it's something that maybe is more decentralized. You don't have like a few, big funds in the space or a few big market makers controlling your liquidity. You have a bunch of people, and I think that can help build like a more resilient protocol. So a lot of ways, I think our ideologies on what crypto should be and how to build a protocol are similar. So I think that really connected us. And I think in terms of the proposal, I think there are a few products we could build for GMX that would help the treasury, but also, as the emissions start to decrease, a lot of that revenue will compensate for that. But the opportunity costs, the opportunity cost of not staking will be lower. So you might see some people on staking, providing liquidity in AMMs, and just giving them, better yields or ways to hedge IL. Plus, there's also a new structured product we realized we could build. Before we really realized we could build these types of calls and puts on our platform, we initially were looking at a lot of like perp platforms and ways maybe to hedge if they have an AMM to hedge their AMM. What we also realized is when you combine like a perpetual feature with one of our straddles, you basically get a synthetic call and put that's hedged. So there's less liquidation risk if the price moves against you, but you can also get like more leverage maybe than the calls and puts you're able to get in our platform. So it would be kind of on the assets that are supported by an Oracle, but it's a very unique instrument in the sense that it's hedged and still getting large leverage. So that's a product where if the token swap goes through, we'll be building with GMX, and I think would attract sufficient liquidity or a little bit more fees to both of our platforms. Yeah,
it feels like a very natural and synergistic kind of collaborative relationship, that one. Again, as you're saying, both innovative products in the space. So I'm happy to see where this one plays out as a very long-term GMX holder and fanboy.
Yeah, I remember I really admired what GMX had built in a lot of ways. When we were first kind of thinking about building a community or building our protocol, we like looked to GMX a lot. And I actually had met CoinFlip and one of the other co-founders at a conference, and they didn't tell me they were part of the GMX team. But like a few months later, I had a friend who introduced me to a fund that one of the GMX co-founders was a part of. So then that fund had invested, and then they heard about that, and then they realized that they had met me at the conference and reached out. And I was like, oh, yeah. I think in a lot of ways too, I like how they keep like a low profile. I think, sometimes
like, right. Yeah.
Yeah. Like founders would get a lot of attention. I think it's good for projects too, but sometimes, we've seen it kind of like play the other way. So I've just really respected the way they've kind of like gone about building the space, their ideals a lot, and it really meant a lot to me that they, believed in us and also wanted to partner.
Yeah, I couldn't speak highly enough of those guys. Like maybe even 14 months ago, just at the kind of beginning, really. Every time I was just reaching out, I was just like, can I get some more information? I'm writing an article on GMX. Yep, nothing was too much to ask. Just anything I ever needed. Just really welcoming, really happy to kind of chat and talk it out. I had CoinFlip on. Probably should be due back on, to be honest. It was quite a while ago, but yeah, as you say, everyone seems to have the same opinion of them as well, which is always great. And the I suppose this is a good question as a good segue. How is, based off the kind of GMX community, what you guys have kind of learned there, is there any kind of humble beginnings of a GammaSwap community? How's that kind of thing shaping up? What kind of feedback you getting? What's that starting to form like?
Yeah, I think like GMX was interesting. I think it was kind of like a combination of two communities that came together and kind of formed immediately as a DAO, and then also kind of have this like decentralized like larger team or community kind of like building towards that. I think our way is probably, I guess, a little bit more traditional for a DeFi protocol. We had a smaller core team kind of like building towards the protocol with the ideal is becoming more decentralized, but yeah, just trying to get awareness out there and feedback. And so I think, yeah, a lot of the initial community members, joined. We're asking about like our protocol mechanisms, like how exactly like everything works. And we realized like, okay, we actually should explain things this way. And a few people even came to us and we realized, okay, like this is something we didn't think about. Like we should think about how we should, like secure a protocol against this, or think about like scalability in this way. And then as it kind of grew slowly, and then as I guess we started to get a stronger presence on Twitter, and especially when we released our testnet, that's when people started talking about us a lot, and our community has grown a lot. So yeah, it's been super busy, but I think now we've been able to breathe a little bit since the testnet's been out for a while, and now trying to schedule, I think, more things like this, because I've also realized like everyone digest content in different ways. Like some people like podcasts, some people like Medium, some people like tweet threads. So making ourselves available, just like online, and also about like how we're building, but also trying to put out content in different ways so that depending on people's preferences, they can digest it the way they want. And honestly, for me, I thought GammaSwap was super interesting. It took me like a solid 2 months to fully understand what GammaSwap was and like what it was capable of. And that's when I started to get really excited. So, I'm one of the co-founders, so I can understand that it's not an easy thing to take into consideration. You probably want to consume, like there's probably a few times you'll need to like read about it or consume content different ways to like digest it. So I think it's important to give people that means and like those options.
I'm gonna make it my goal of February, because I'm packed out until then, to get this protocol in a way that is very much ape friendly. I don't know how I'm gonna do it yet. I haven't figured that one out, but that's my goal.
What we've been kind of harping on is like, okay, you're an LP, you earn higher yield for basically giving people the option to buy those options. And on the other side, now you can buy options on any token. You can't get liquidated if the price moves against you. If there's any volatility, you're going to do well. If there isn't, you're probably not. So I still don't think that's like super clear on exactly why people would ape in, but that's kind of like what we're harping towards. It's like now you can buy options on any token. It's totally different liquidation mechanism than a typical like perp feature, and LPs earn more yields. And then if you want to understand exactly how everything's going on the back end, like we have all that content, but you can also, we'll get audited, and we'll also try to have just general mechanics out there as well, so that someone could maybe read it in 10 or 15 minutes, and maybe they don't know how everything exactly is happening, but they have a general idea of, okay, this is kind of what they're doing, and this is what I get when I buy an option, and this is what I get as an LP.
Yeah, it makes sense. I'm gonna make like one of those bell curve memes where it's just like on the left side it's impermanent gain, and on the right side it's impermanent gain, and in the middle it's like all the math that goes into it.
Or impermanent loss doesn't exist.
Who you touched on audit there? Who are you guys going with?
So we're at the tail end of finishing up our Halborn audit, and then we're gonna have another firm on retainer, Zelic, for like 6 months, just because we will have new adapters and new products that we're building. We might do a code for Arena audit or some type of bug bounty. We're still looking into exactly which one we want to go with, but I think having something like that is probably good as well, just to get more eyes on it, or kind of like like a bug bounty is kind of like perpetual audit, I guess. So something there just to make sure that we're covered.
That is like that's taking the idea of, if you want the right answer on the internet, just put out your own opinion on it or something, or however that phrase goes. If you want the right answer, just put out the wrong answer or something. You know you're going to get a good response of someone, because everyone likes to prove everyone wrong online. It's like
For sure.
the crypto answer to that. So for those who are unaware, which chains will you be launching on? Chains?
Yeah, we're so our home's gonna be Arbitrum. That's where our token's gonna be. That's where we probably have the most like partners interested in collaborating with us. Mainnet still has a lot of liquidity, so we're going to launch on Mainnet and Arbitrum. I think in a lot of ways, our solution will operate better on Arbitrum just because the latency is lower and the fees are lower. And yeah, especially with like an option on altcoin, like that low latency is important. But then Mainnet, I think the IV in some ways is even more depressed because there's so much more liquidity. And yeah, there isn't actually, options available on a lot of those mainnet tokens. So I think that we'll still get really good utilization there. Maybe some of the option strategies are a little bit more passive, but yeah, I think there's a lot of liquidity there as well. So those are two we're focusing on. We might expand to some other EVM chains after, still kind of to be decided, but yeah, we'll probably, no matter what, be staying within the EVM ecosystem.
Yeah, makes sense. So just getting to the kind of top of the hour, is there anything that people should be keeping their eyes out for in the short to medium term? Like what should be kind of next on the agenda?
Yeah, so we'll probably have some sort of alpha testnet beta testnet before our mainnet. So I think people should be looking out for that. And then a mainnet launch. I think we were aiming for end of January, which I think we're always a little bit more ambitious than we should be with those timelines. So it's looking more like end of February. But I think the biggest, we probably could have launched now because all the smart contracts are audited. The only thing is the UI, and we want to make that, more accessible to people and more retail friendly. So that's what we've been spending most of our time on now before the launch. So that's why the deadline's a little bit later, but I think like end of February, we'll definitely have like a beta testnet, if not mainnet, out by that time.
Yeah, I know what it's like when you're ready to get something out the door. It's you want it done yesterday, but it's it'll be worth the wait, man. Definitely, 100%.
It's always frustrating, but it's important to take the time when the time is needed. So that's kind of the compromise I'm making in my head. But yeah, it's definitely like I just want to get it out and get going. But it's not always that easy.
I wonder if it's like a New Year's party where you build it all up and then it hits 12 and it's just like it's launched. It's like, all right, now what?
Yeah.
Now what do we do?
I think when it's launched, I'm gonna contact my friends again. They probably thought I went missing or died for a little bit. So
Missing person.
Them.
Yeah. You're on cartons of milk all over the US.
Yeah. Get some calls in, catch up, and then kind of back to work. There's a lot of we honestly have a lot of ideas for other products that we think will be really innovative. Some honestly that might break DeFi, but it's kind of contingent on this model working. So we want to get liquidity into this, and then we have a lot. I know a lot of people say this, but for us, it truly doesn't stop after mainnet because we have all these other products we want to launch that would, take advantage of the ability to take both sides of this liquidity provision trade. So I think you'll also see. I don't think it ends with being able to short liquidity in AMM. I think you're going to see a lot of different products from us that kind of touch like different categories in DeFi.
Nice. Well, at the time post-launch, let's run it back, show people the nice new UI and everything like that. We'd love to get you back on if you haven't kind of ran away with your friends off to have a party for once. But more than welcome anytime. And what's the easiest place to find you guys? Obviously Twitter's quite an easy one, but
Twitter's good. We have our Discord link in there as well. Medium for maybe people that want to do like more research or a little bit more technical. And then we have like kind of like our landing page, I had a wait list. I was trying to send emails to people on MailChimp to notify them of the testnet, and MailChimp basically banned us. They're like, yeah, we don't support crypto companies.
Yeah, you need to get off.
Yeah.
Crypto companies are prostitution, like exactly.
I was like, okay, nice category.
Yeah,
and I checked
on
another
Beehive.
Beehive. Okay,
That's
noted.
the one.
I'll look into that one. Yeah, there are a few other ones too that had a problem with crypto companies. So if Beehive works, we'll be sending out some emails. But right now it's just like waiting list for emails. We'll have a new landing page or website that'll be a little more informative coming out soon. And then we'll connect that to the app as well, the beta testnet, and then the actual full-fledged app.
Awesome. Well, we'll be kind of cheering you on from wherever we can. As I say, happy to have you guys on whenever. Might be a good one to get as the protocol's rolled out. You and I think CoinFlip's doing a lot of the kind of social aspects of GMX at the minute, isn't he? So maybe that'd be a nice round table, see some synergies there, and get you both on, and we can just have a party online.
Down for it. Yeah, we can find something to celebrate at any point in the
year. Right. Appreciate your time, and I'll speak to you soon. Thanks again.
All right. Yeah. Thanks, Grant.
All right. Take it easy.